Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at WisdomTree Asset Management. All right, let's stop with the rate hike talk already. Coming into this year, it was safe to say that all of the attention within the money and bond markets was on Fed rate cuts. It wasn't a question of if, but when and by how much. And well, we all now know how that narrative has turned out so far this year. In fact, just within the last few weeks, the whole rate discussion was turned completely around, as, believe it or not, the Treasury arena was actually contemplating the exact opposite. Could the Fed give us a renewed rate hike? So how did we go from point A, rate cuts, to let's call it point Z, a rate hike? Well, certainly the economic data released in April was a starting point, specifically on the inflation side of the equation. CPI and PPI both came in hotter than expected, basically halting the disinflation trend that had been prevalent in 2023. And add on to that, the labor market data was also revealing new momentum in job growth, and consumer spending, when you looked at retail sales, was also solid. But the final piece of the puzzle seems to have been a comment from New York Fed President Williams, and he's considered to be one of the Fed's three official spokespersons. It's usually the Fed chair, the vice chair, and the New York Fed president. And while he said that a rate hike is not my baseline, he did say it is possible if the data warrants such a move. So needless to say, the Treasury market did not greet this headline favorably. The 2-year Treasury yield hit a pre-May Fed meeting peak of 504, the highest reading since November, and the 10-year yield hit 474 on an intraday basis for its most elevated level since October. So in other words, the incredible rally we saw during Q4 was getting closer to being reversed entirely. So why is this important? Because it explains why the Treasury market reacted in such a positive fashion to the results of the May meeting, the Powell press conference, and then the April jobs report, which just followed. Without this context, the May Fed day probably would have been viewed as being neutral, with a case perhaps to be made that a hawkish spin was on the Powell presser. Instead, the money and bond markets focused on Powell's downplaying the chance of a renewed rate hike. But if the whole rate hike narrative hadn't been reintroduced, the focus probably would have been on the Fed chair's statement that gaining confidence to cut rates will take longer than originally thought. And once again, let's add on to this. And although the employment numbers didn't meet consensus forecasts, they still revealed a relatively solid labor market setting. So the bottom line is that higher for longer remains a dominant theme here for the U.S. bond market. And against this backdrop, investors should consider turning to the WisdomTree suite of Treasury funds as a toolkit to position their fixed income portfolios for both the current and prospective rate outlook. And they consist of the WisdomTree Floating Rate Treasury Fund, ticker USFR, as well as our two new Treasury laddered fund, the WisdomTree 1 to 3 year ladder Treasury Fund, USSH, and the WisdomTree 7 to 10 year ladder Treasury Fund, USIN. So I'm going to end it there. Just wanted to provide some recent insights that have been gaining a lot of attention, some solutions we think make sense going forward, given what we're seeing in the bond market for the rest of this year and perhaps 2025. Have a great rest of the week, everybody, and be well. And before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.